morning, everyone, and welcome to our second episode of Checks, Chats, and Chardonnay. I am I am Stephanie Bowden with Ascend Wealth, and with me is also Mary Jo Warner, and we have a guest with us today, Terrence Taylor with Tailored Tax Partners. And so, first question out the gate is, how are you? How are you doing? How's your family? All those good things. So, Terrence, since you're new, you want to just jump in and tell us just a minute about you?
Yeah, sure. Well, first of all, I am effing fantastic, and I haven't even had Chardonnay yet. And second of all, my family as well. Thank you so much for asking. My daughter is graduating this year, so prom is coming up, and we're super excited. Graduation is on the 27th. My son is ready to start practicing driving. So
Wow.
I'm excited because I taught my daughter, I'm going to teach my son. My wife wants no part of that. And I remember though when we were teaching my daughter, the insurance suddenly went up from like $100 a month to $600 a month. So I'm wondering how much is going to go up when we add him to that. So I'm not looking forward to that, but it's a rite of passage. So it's so much of a blessing to be able to be there with them in this pivotal moment. So that's me and my family. And thank you so much for inviting me and Taylor Tax to come and answer some questions and share some insights, hopefully some actionable insights in terms of how people can save a bunch on taxes legally and perennially.
Yeah, I like the legally interjection. That's very important. Thank you.
Yes.
Yes.
Mhm.
Yes. We don't
All
want
right, Mary
any.
Jo. Sorry, how are you doing, Mary Jo? How's it going with you?
I'm doing great. I'm doing great. Had a wonderful Easter. And right now my dogs are all outside with Antoine, my husband, and which is a good thing because they would be barking like crazy right now. So we don't want that. But everything is going amazing this morning. It is sunny. It is beautiful in New York. And that makes us all feel amazing, of course, and it's rare here in New York, that upstate. So, especially for it to be 70 and sunny.
Oh, wow, that's like
I
flip-flop weather.
I know, I know. Well, for us, 50 degrees is flip-flop weather. Weather. I hate to say it, but it is. We're
Sure.
we're like, get those boots off from the winter. It was such a rough winter this year.
Mm.
So it was great, but everything's going great here. It was great.
Good, good. I'm glad you're having some good weather. So, I'm in the state of Washington, the great Pacific Northwest, not far from Seattle. And, they say it rains every day. Spoiler alert, it is bright. I see not a cloud in the sky as I look out my window. It is sunny. It is going to be in the middle to maybe high 60s today. So, but don't tell anyone because I don't want us to get too crowded up here.
Yeah.
Well, so Mary Jo, I think you had a question to kick us off with Terrence. If you want to go ahead and jump right in, let's learn a little bit
I
about taxes and how we can legally pay less.
Yes, I do. So Terrence, as a young professional starting
Mhm.
out in life, and especially like your daughter's going to college. She's
Yeah.
soon going to be a young professional.
Yep.
What tax strategies would you recommend to help build a strong financial foundation to ensure a longevity success?
Hey, what a fantastic question for us to open on. So, the first thing is, I would want each and every young professional to understand how to master the tax game. It is a game, and guess what? There's a playbook for the game. Sadly, many of us are not taught this until we're much, much older. That tax playbook is called the Internal Revenue Code. Now, you may be thinking, as a young professional, I want no parts of anything to do with the IRS, and I understand, but I'm going to break it down for you in terms of principles and in terms of levers, and then we can get to the strategies. So, principle number one, you need to prepare a plan for how you want your taxes to go. Principle number two, you need to document how you go about your tax affairs. Principle number three, you need to ensure that you understand the definition of income and how it's taxed. Principle number 4, get this. You need to understand that in the Internal Revenue Code, debt, D-E-B-T, is not taxed. So you can get money from income, which is taxed, and the more income you make, the more you're going to be taxed. You could also get money from debt, which is not taxed, and there are strategies around how you do that, which leads me to principle number 5. When you want to play the tax game to win, there's actually a strategy called buy, borrow, die. I know it sounds morbid, but it's a fascinating strategy. BBD, buy, borrow, die. The implication is you want to build up assets, especially now that you're starting out and starting to make money. And then you want to have assets that will appreciate in value. And then you want to leverage or borrow against those assets, because once that money is in your hand, because it's considered debt, you're not going to be taxed on it. And then you want to arrange your estate and your financial affairs in such a way that you can pay back those debts when you're ready to. So there are ways that you can borrow money where you don't have to pay it back right away. And I'm sure Stephanie and Mary Jo can share with you some of those. But spoiler alert, Stephanie's favorite expression, one of them is insurance. And we'll talk about that. So think about those principles. And let me jump quickly to the levers. So the levers involve things like understanding that real estate is one of the most tax advantaged activities and asset class when you're playing the game to save on taxes. I know Mary Jo likes that.
You do.
Second one, Stephanie, Mary Jo, and I all love this. Insurance is one of the most flexible tools that you can use to arrange your financial affairs so you save a bunch on taxes legally and perennially. Third, since you're starting out, there are ways to set up your retirement savings that allow you to have a tax-free or at least a tax-advantaged retirement. Fourth, and this might be one you even want to start thinking about right away, is creating a business or a side hustle. Because once you have a side business, the IRS allows you to take a lot of deductions and to arrange your affairs so you can shift income. Fifth, start to learn how to practice strategic gifting. So when you use charitable giving, there are ways that you can structure that so that you get significant savings every year on your taxes. Picture being able, for example, to get a write-off of between 30 to 60% of what you make as income from doing charity. And with charity, there are many different ways you can do this. Okay, so I could go deeper because there are more, but I'm going to pause there and say, for those who are just starting out, these principles and these levers and understanding that this is a game that you can play to win, that's the best way to start.
I have a quick question. Where would you find that playbook?
Well, I mean, luckily there's a company called Taylor Tax that actually has that playbook. So you can get in touch with us and we'll very happily share that with you. So my email address is Terrence, Terrence, at taylortax.ai, taylortax.ai. So get in touch and we will happily share that with you.
Oh, that's amazing. Thank you so much, Terrence.
Yeah.
Wow. I'm excited. I didn't know about the charitable donation thing, so I'll be getting that playbook as well. And you know what? As I think about it, I'm so glad that we're doing this podcast because that means I have a recording that I can go back and listen to over and over. Because like I wanted to take notes, but I also wanted to listen and just So fabulous. Again, thank you, Terrence, for being with us. So excited.
Sure.
So I have a question. When I was a youngish adult starting out, people told me 401k, that's what you do for retirement. Social Security won't be there. Dump all your money into your 401k as much as you can. Like if the employer matches, that's great, but just as much as you can put in, and don't worry about it. It'll go up and down. And when it's time for you to retire, you'll have money for retirement. That's literally what I learned. And like an ostrich, stuck my head in the sand. Didn't even kind of ask a lot of questions. And I did that for many, many years. So I guess my question is, as I think about those employer type of retirement plans, like 401k or 403b, that type of thing, it's tax deferred, meaning that more of my paycheck money gets to go in because I haven't paid taxes. So when I am retired and I pull money out of a 401k, what happens with my taxes?
Stephanie, this is what I was also told, and I'm sure Mary Jo was also told this. And for
Mhm.
those young professionals that are starting out, thank God you found this podcast. First of all, to answer your question directly, and then we'll come and deal with the taxes and how to avoid them legally and to have much more of your money in retirement. You are going to be taxed. Worst of all, you're going to be taxed at the behest of the federal government. What do I mean by that? So the first thing is the federal government has made a deal with you. You've unwittingly accepted this deal, and it works out for some, but sadly not for most. The deal is don't pay taxes on the seed, pay taxes on the harvest. So let me say that slowly. The federal government said to you, I'm going to give you this wonderful thing called a 401k where I'm going to defer the taxes. So the implication is you could have paid taxes up front, but no, you're not going to do that. You're going to wait until that money has grown for decades, especially for young professionals. Or now that you're facing retirement, or maybe 2 years out, 3 years out, 5 years out, or at the stage of retirement, now you start wanting to withdraw the money, then they say, fantastic. So let me give you an example, Stephanie. Let's say you were lucky to save 100K in your 401k, and now you're retiring and it's actually grown to 1,100,000. The government says, fantastic, you've done so well. So what we're going to do is you can now start to withdraw money because you're 65, and you're going to pay tax every time you withdraw money. And the only thing we're going to do is we'll just take tax on the difference. So you put in 100K, right? Yeah, fantastic. The million is actually what's known as capital gains, right? Because the money that you put in was invested, most likely in the stock market. So it's increased 1 million. So you're going to pay capital gains on it. And as you're paying the capital gains, you're paying the capital gains on the million. So now imagine you were so excited because you had made 1 million. Now the government is saying we want our portion of that million. And depending on your tax situation, if you're lucky, maybe you get 20% tax. So 200,000 goes to the government. If you're unlucky, you might get as much as 50% tax. So 500K goes to the government.
Oh my goodness.
Yeah. Right? So Stephanie, that's what we're dealing with. But now here's the wonderful thing. Because you are in the process of saving for your retirement, for those who are not at retirement stage yet, you can do something about it. There are different parts of this playbook that I told you about. And remember, I told you insurance and retirements are two levers that you can pull. There are different parts of this playbook that allow you to save for your retirement in other vehicles that don't have this don't pay taxes on the seed, but pay taxes on the harvest feature. So you could take, for example, like those of you who already know about this, you could use a Roth IRA, for example, or Roth 401k if it's allowed, where you pay taxes on the seed. So as the money grows, you don't pay taxes on the harvest. So let's look at that same example with a Roth. You put in 100K, you pay the taxes up front. So even if you were forced to pay 50%, you paid 50,000. Now, if your 50,000 grows 10 times, so now worth 500,000, Stephanie, are you going to pay any tax when you take that money out in retirement?
No, I don't think so because I already paid taxes on the seed.
So you paid 50,000 versus in the first example, 500,000. 1/10. So that's much better. And then the other thing you can do, of course, is you could save for your retirement in a cash value permanent insurance policy. And because the money that goes in is after tax money, you would have already paid money on the seed. So as you withdraw money in your retirement years, that money, when you structure it properly, comes out tax free. Now, of course, there's some details, but that's why you will reach out to Stephanie or Mary Jo or me to get the details of how that would work for you. So I could go deeper, but Stephanie, I hope that answers your question.
Yeah. Yeah. So if I had a 401k or a 403b,
Mm-hmm.
how could I know how much money I'm even going to have at the point of retirement? Is there a magic formula or magic wand?
It's a great question. So let me tell you what the financial planners have been taught to figure out for you. Yeah. They use something called the 4% rule. And that's a rule that was based on a study that was done by a money management firm. The person who did the study's name escapes me, but if you look up the 4% rule, if you Google it, or if you're using ChatGPT or Claude or any of the large language models, AI models, you should be able to find it. And what they what they discovered is it's a rule of thumb, right? So it's really good to have a certain amount of money that allows you each year to take out just 4% of it and give you whatever it is you're looking for in retirement. So for argument's sake, let's say someone wants to have 10,000, in 10,000, they want to take out 10,000 in their retirement years, right? So if we use the 4% rule, how much would we need to have saved in retirement to be able to take out 10,000?
$400,000.
Let's
Is that
see.
right? Did I do the math? It is still early. Hold on, let me grab my Chardonnay.
I think it's 250. But just correct me if I'm wrong. I think that'd be 250, right?
I don't know.
Yeah.
My calculator.
I'm gonna get the calculators out.
Right.
Everybody get the calculator.
That's right. Terrence is having you do math. And let me just confirm for myself. I think that's 250, but I'll do the math quickly. So
it is 10,000.
Yep.
But now let's say but 10,000 may be enough for you, right? On an annualized basis. But I think in the United States, we might need a little bit more. And remember, this is before you're even taxed, right? If you have a regular 401k. But let's say you want 100,000. Now you need 2.5 million.
Mm-hmm.
So it comes down to how much do you have saved and how much do you need. If we use the first example of the 1,100,000, and let's make the math simple and say it's now 1,000,000. So if you have 1,000,000, that's only going to give you 40,000 a year.
Wow.
And then I still have to pay taxes out of that.
And you still have to pay taxes out of that
I still have to buy groceries and laundry soap and toothpaste and put gas in my car, even if my house is paid for. And
you still need money for Chardonnay. Let's not forget that.
Yes, I know.
Well, that's on automatic.
That's important.
Yeah.
That's important.
Yeah, that comes automatically. It comes right out of my checking account. I don't even pay for that. I mean, I don't have to write a check.
Yeah. So folks, why are we sharing this and why are we making sure you understand this? The good news is once you know what happens with your retirement savings, then you may decide that, wait, but I actually want to do something about it so I get A, the money that I want and deserve, and B, I want to set it up in such a way that I get the lion's share of the money. I don't want it going to taxes. And it doesn't have to go to taxes. You just have to structure it correctly. And there are many strategies that Mary Jo and Stephanie can help you with. So you can make sure that most of your retirement money comes to you as tax advantage or as tax-free as possible.
I have a quick question.
Yeah.
So a lot of people are going to say, but my company matches.
Oh, yes.
They give us 3%.
They do.
Should they put more in? Because they say, but if you put in extra, you're going to have your retirement sooner. And this is what they tell them.
Yeah.
And I've heard young kids tell me this stuff.
Yep.
I would suggest,
Yeah.
and I'm hoping that you agree with us,
Go for
that
it.
the 3%, yes, take free money.
Of course.
Don't put any more in.
Yeah, every day, all day. Take as much of the free money as they're willing to give you. And then once you get there, start looking at the other more tax advantage ways of saving for retirement. So
Mm-hmm.
let me give you an example on how those levers we spoke about can work to your benefit. For argument's sake, you started your own business. And for those of us, for example, who are helping people with their financial strategies, we have a side business, right? That business now allows you, just like your employer does, to put together a retirement plan for you. And guess what? Unlike the plan that you have, the 401k with your employer, which restricts how much you can put in, the plan that you can create for yourself through your business, you could actually set it up in different ways. And based on how much income you generate in that business, did you know you could save as much as 69,000 per year for your retirement?
No.
Yeah. Or
Pretty hefty. Yeah.
hefty. Or did you know that you could save sometimes even up to 250,000 via your side business for your retirement?
Wow. No. And everybody out there is learning it right now. They didn't. I know I didn't know it, so I know a lot of other people didn't know either.
That's right. So this is the beautiful thing. When I say to you that the game of taxes is something you should learn, like I was a huge Game of Thrones fans. I was a huge Game of Thrones fan. And for other Game of Thrones fans out there, first of all, let's have a moment of silence for the last 2 episodes. But now that we're back, it's like that. Game of taxes, let's have fun with it. Let's understand the characters, the principles. Let's understand the rules of the game and how we can play it, the levers, and let's put together strategies that work for you. So at the end of it, you're sitting on the Iron Throne and you make that game of taxes end the way you want it to end.
Right. And this really helps like the approach of retirement as well.
Yeah.
I mean, older people that are needing right now to protect their assets,
Yeah.
minimize tax,
Yeah.
and liabilities, and maximize their retirement income. That's what they really, because when you start young,
Yeah.
you're working that game
Yeah.
to be able, when you go to retire or just before you retire, you can say, I'm going to be comfortable.
Yeah, exactly.
That's, that's where we're all at. And there's so many people out there that don't have this knowledge. They don't even have the game. They're not even in the game. Let's just say it. They're not even in the game.
That's right. And here's the sad thing and the sad truth. When you don't know the rules of the game, you are considered an unsophisticated taxpayer by the IRS. When you know the rules of the game, you are considered a sophisticated taxpayer by the IRS. And guess who the IRS gives a lot of leeway and flexibility to, even when they do audits? Sophisticated taxpayers. So if you don't know the rules of the game, they're coming for you. Sorry to say. When you know the rules of the game, then the IRS becomes your partner.
Well, they can't pull the wool over your eyes. That's why.
And here's the beautiful thing. They don't even necessarily want to pull the wool over your eye, but some way, somehow, we've been so misinformed and miseducated, like what Stephanie was sharing earlier about save and put your money here and do this with your money, that when they see people who are doing that, they know you're not sophisticated. And then the tax code is actually used against you. When you show that you've actually taken the time to understand the rules of the game, then they're like, okay, so this is someone that understands that the tax code is an incentive system by the federal government to tell people what the federal government wants US citizens and taxpayers to be doing to build this country and this society. So if you are contributing to that by, for example, investing in real estate, starting a business, using instruments like life insurance for saving for retirement and other things, doing charitable giving, saving for your retirement through other instruments other than 401k, you're actually playing the game. So that's how you show your sophistication.
And it's never too late to learn.
Never too late. I learned this in my 50s. I'm turning 54 this year. I learned this in my 50s because I got sick and tired of not understanding the rules of the game. And when I was told that I was considered an unsophisticated taxpayer, that was my wake-up call.
Yep.
Yeah.
Game changer.
Mm-hmm.
Mary Jo, there was something we spoke about earlier that triggered something for me. And I thought it would be helpful to give people a concrete suggestion for those who are already having 401ks. And, the market right now is really frothy is a word to describe it, but it doesn't quite capture it. Like it's really volatile and, causing a lot of anxiety, and people are losing their retirement savings, which is not good at all. So I wanted us to offer them a ray of light and very concrete suggestion of what they can consider. Now, of course, this is general, so it's for information and education purposes. For those who want to do something specifically for yourself, then you must consult with either your financial planner, your retirement planner, a tax professional, whether me or someone else, or a licensed financial professional, Stephanie, Mary Jo, and myself also. So listen for the education, but when you want to do something for yourself, get in touch with those of us who can help you. Okay, so if you have money that's sitting in a 401k, your money is currently invested in the market. The market is doing what the market is doing. Many people are losing quite a bit of money. And, we've seen this story before, 2008, 2022, right? So worst case, it could go down tens of percent, 30% plus, whatever the case might be. What if there was an instrument that allowed you to take your money, your retirement money, which is considered a qualified plan by the IRS, and put that money into a product that's also considered a qualified product? Well, if you put that money in that product and that product then protects your downside so you don't lose any money, doesn't matter what the market does, right? Then first thing is when you take the money from your 401k and put it into that product, and the name of that product, by the way, is an annuity, then a fixed index annuity, then you first of all don't pay any taxes on the transfer. It's considered a rollover. And then second of all, now you have your money that has a floor where it can't go any lower than what you have it at right now, right? So that's one thing, you concretely protect your downside. And then for those who want to get more sophisticated, there are strategies that would allow you, even before you're 59 and a half, for those who haven't reached that age yet, to take out up to 10% of that money on a penalty-free basis. Right. We know right now, if your money's in a 401k and you take out anything from that before you're 59 and a half, you got to pay a 10% penalty, and then you pay taxes on the money because it's considered a distribution. Well, in this case, if you do take out the money, at least the 10% penalty is not there. It's still considered a distribution, and you pay the taxes on that. But remember what we said, pay taxes on the seed. And now you have after-tax money to put into those fabulous products we told you about, cash value, permanent life insurance, that would then allow you to grow that money tax-free. And when you structure how you take out the money properly, you will get that money out tax-free. Remember that principle, debt is not taxed. So part of the structuring of how you take out the money from your insurance policy could be through what's known as a policy loan. I'm just going to stop there.
That's amazing. I mean, isn't that amazing? Wow. You just gave us a mind-blowing strategy.
Mm-hmm.
Mind-blowing.
Yeah. And you know what that made me think of? Do you know who Warren Buffett is?
I do. I adore him.
He has 2 rules of money. Have you
Yes.
heard those rules? Mary Jo, have you heard those rules?
I believe so.
Yeah, I think so.
Okay. Well, I'm just gonna, spoiler alert, here I go again.
Go for it.
And actually rule number 2 is my favorite. Okay, so
Yeah.
Rule number 1, never lose money. right? And so you were just speaking to that, Terrence, that there's a strategy to take the money out of the stock market, like in a 401k or 403b, and put it into something that it's protected so you never lose any money that you've already made. So that meets rule number one. Rule number two being my favorite, never forget rule number one.
Yep.
Perfect.
It is perfect way of saying it.
Yeah, for sure. Well, Terrence, thank you so very much for spending time with us today on this sunny spring morning.
Yeah, this was fun. A lot of fun.
Very much appreciate it. We'll definitely invite you back. But anybody out there listening, you heard it first here. You can get the playbook from Terrence. Just send him an email and find out more information. So thank you so much for your time today, and we'll talk to you soon. Have a great day, everybody. Bye.
Thank you. Have a good day. Bye.